The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled The Section 72T Exception to the Penalty Tax. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar. And here he is.
Thank you very much, Amber, and welcome to everybody who's joined us today and those of you who are listening to the recording. I'm glad you joined us for the Section 72 exception of the penalty tax webinar today. I want to remind you that we conduct these webinars on the first Wednesday of every month, and the webinars are available to anybody who's in the financial services industry. They're free of charge. And the next one will be on Wednesday, May 1st at our usual time, 11 a.m. Central, and the topic will be state income tax and withholding rules. So glad you joined us today. Feel welcome to join us for that one if it's of interest to you. We do post our webinars on our YouTube channel, and there'll be more information about that at the end of today's presentation. Before we get into the meat of today's webinar, let's go ahead and decide on what it is that we'll talk about in June. And as always, we'll allow you to choose. Your three choices for June's webinar are, first of all, reviewing Form 1099-LTC. Secondly, unique indirect Section 1035 exchange. And the third is fighting with the IRS. I'm going to go ahead and open the poll and invite you to vote for your choice. I'll give you about 30 seconds to do that. A couple of you haven't voted yet. Please go ahead and do so if you're interested. All right, thank you very much. I'm going to go ahead and close the poll. Next month, we will discuss a unique indirect Section 1035 exchange. Thank you for that. All right, let's go ahead and get into the meat of today's webinar, the Section 72 exception to the penalty tax. Here's what we're going to talk about during our 15 minutes or so together. First of all, we'll talk about the background of the penalty tax and the penalty tax exceptions. Secondly, we'll talk about special rules that apply to substantially equal distributions, which is the specific 72 exception that we'll be talking about. We'll discuss the calculations that the IRS has approved to figure out the 72T distributions that are exempt from the penalty tax. And then we'll give a few final thoughts that Jennifer and I have as we answer questions from producers about 72T. So let's go ahead and start with, first of all, the background. So I want to mention up front that while we're talking specifically about Code Section 72T, the rules that we're going to talk about also apply to non-qualified annuities. Non-qualified annuity distributions are taxable gain first, and the taxable portion of non-qualified annuity distributions are potentially subject to an extra 10% penalty tax, just like IRA distributions are if they're taken prior to age 59 and a half. And this is taken directly from the IRS's website, where they talk about taxation of IRA distributions or qualified plan distributions. Distributions taken prior to age 59 and a half are subject to an extra 10% tax unless one of the exceptions applies. The IRS specifically in this excerpt talks about medical insurance payment after a job loss. There are lots of potential exceptions that apply that would relieve somebody from the obligation to pay an extra 10% tax on a pre-59 and a half distribution. The IRS has a chart with all of this there. I've reproduced the chart here on the slide so that you can get an idea of whether an exception is available and whether it's available for just IRAs or qualified plans or both or either. If you have questions about that and you can't find the chart, feel welcome to give us a call. We'll point you to it, but there you go. So let's talk specifically about the rules that apply to the Section 72 exception, substantially equal distributions for life expectancy, which is what we're talking about today. The distributions must be based on the account owner's life expectancy. A lot of people are confused when they call us. They believe that simply taking 5 equal distributions will qualify for an exception to the penalty tax, and that's not true. The distributions have to be based on the account owner's life expectancy. Life expectancy tables or actual life expectancy annuitization, that's what's used to come up with the substantially equal distributions calculation exception to the penalty tax. When calculating the distributions for 2 of the 3 approved methods, you're also using an interest rate to calculate what the distributions need to be. The interest rate is the higher of the higher of 120% of AFMR, applicable federal midterm rate, or 5%. Once you start 72T distributions, you must keep them going unchanged for a minimum of 5 years or to age 59 and a half, or else it's going to create a tax disaster for the client. And then the 3 approved calculation methods are minimum distribution method, annuitization method, or amortization method. Those are the main rules that have to be kept in mind with regard to 72T. So let's talk about the calculations. There are 3 IRS approved methods for coming up with 72T distributions that are exempt from the penalty tax. And the information for this is at the website link that's shown on your screen. So I stressed earlier in this webinar that life expectancy is used to calculate the minimum distributions that are needed to conform to 72T. And the IRS has said that you use one of any of these tables to determine 72T distributions. You can use the uniform lifetime table, you can use the single life table, or you can use the joint and last survivor table if a couple of boxes are checked. The boxes that need to be checked to use the joint and last survivor table is that spouse needs to be 100% beneficiary of the account, and spouses need to be separated in age by more than 10 years. Under those circumstances, you can use the joint and last survivor table. Otherwise, you're stuck with one of the first 2. And in general, most of our clients are going to choose to use the single life table. The IRS gives some examples on the web page that is linked about what kinds or how the calculations are actually done. I'm not going to go through these with you. I'm not going to read them to you. I will make a couple of points though. The first one is that very few people, if they're doing 72T distributions, are going to choose the RMD method for calculating. Why is that? Well, the RMD method is the mechanics of it is that a 72T distribution will work much like how an RMD distribution is calculated. You take the beginning of the year account balance, you divide it by the factor from the table, and you come up with an RMD. That's a valid way of calculating 72T distributions. However, it generally produces the lowest initial amount. The amount goes up over time as the account values change and the table factors increase based on age, but it produces the lowest income stream, and that's not usually what our clients are after. We're usually trying to get the highest possible income stream. And the highest possible income stream might be produced by either the fixed amortization or the fixed annuitization method. You got to run the calculator to figure out which actually produces the higher rate. But amortization and annuitization are calculated in similar ways. Factors are used for clients' life expectancy, and an interest rate is also used to calculate the equivalent of a present value stream, or a zero out stream at the end for the account. I explained that badly, and I explained it badly on purpose. And the reason I explained it badly on purpose is this. There are excellent online calculators for calculating what 72T distributions should be given a particular client in a particular account, right? So Jennifer and I like this one from the website listed. We've got no financial interest in this particular website. It's just that we found that the calculations produced by this calculator seem to be accurate, and there isn't a lot of extraneous material. It's not a super busy web page. We like its simplicity. So you enter the account balance, you enter the client's age. If you've got a spouse that's more than 10 years younger, you enter the spouse's age there. Otherwise, it won't matter. And then you put in the reasonable distribution interest rate, which would be a minimum of 5%. Could be a bigger number if 100% of or 120% of applicable federal midterm rate is higher. And then you click the calculate button, and it tells you, based on the three methods, what your 72T distribution needs to be. Very simple to use, very handy if you're trying to model distribution stream for a client. So what are the final thoughts that we'd like you to take away from this before we wrap things up? Well, first of all, I say this to callers. I know Jennifer says this to callers as well. Think twice before you start a client down a 72T or 72Q distribution plan, because they're locked into it for 5 years or to age 59 and a half. And if they make any change before the deadline, there's a potential for application of the penalty tax, not only on the extra that they're taking now, but on all of the distributions that they took in the past, because those distributions were not substantially equal based on life expectancy due to the change. And so if we've got an alternative, we're always choosing an alternative. We're thinking twice before implementing 72T or 72Q, because the penalties are for screwing it up are a problem. The second thought that we have is that it's now clearly possible to do a partial rollover or partial 1035 exchange for a non-qualified annuity during the distribution phase. That wasn't necessarily the case before. The IRS told us that we couldn't make those kinds of adjustments to account balances in the past. Now it seems like we can, although I strongly urge clients and their tax preparers to be signed on the front end rather than the back end, because the idea that we can do exchanges during 72T is a new one, and you want to make sure that people are signed on to that beforehand rather than creating anxiety on the back end. And no, this next box is not a mistake. Think twice before starting 72T or 72Q. We really do want you to think twice. Therefore, the box is there twice. The next practical tip is that the client think about using an IRA or non-qualified annuity company that does 1099 reporting in a way that is consistent with Section 72T. And helps with the proper calculations. It's so much easier for the client and the client's tax professional if 1099R reporting shows the client is exempt from the penalty tax, if the carrier thinks the client is exempt from the penalty tax. And the only way you're going to get that kind of tax reporting from a carrier is if the carrier is an active participant in the 72T distribution process, helping to calculate and confirming that the distributions are likely to be exempt from the penalty tax. So that's a practical tip, I think. And then if a client wants to plan for retirement income prior to age 59 and a half, wants to avoid penalty tax, before jumping onto 72T or 72Q, consider whether other types of exceptions might be available. The one that Jennifer and I run into the most is the age 55 rule, where distributions from an employer-sponsored plan where the client separated from service from that employer in the year they turn 55 or later, those distributions are exempt from the penalty tax. And so think about that. Make sure that 72 is really necessary in order to meet the client's retirement income objectives. So to close this out, let me make these observations. First of all, Section 72T, 72Q distributions, they're a valid way to avoid the imposition of the penalty tax. We suggest that people take a lot of care and think twice before proposing 72T. Mistakes are easy to make and the consequences are severe. And if you want more information about Section 72T and 72Q distributions, feel welcome to request a copy of the newsletter article on which this webinar is based. Thank you again for attending today. And at this point, let me turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, May 1st, at this same time. Next month's webinar will be titled State Income Tax and Withholding Rules. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.